Hello, this is the ChartProfit video. Approaching 2.5 hours into the trading day on Friday, 4th of March. This is from the pre-open today. If you look at previous comments up here top left, from pre-open on this Thursday here, said that previous day on the Wednesday the E-mini had opened lower, but first level support at 1886.50 held exactly. It's down here, and a strong reversal followed. To keep this rally in a strong position, the E-mini must hold or quickly reject a test of that level, and it's been higher ever since there. What happened subsequently, the following day we had aggressive buying, and then this halfway point, this major half range at this level here, which is 1956.90, which is the half range of last year's high, that came into play here. So we had that rejection. We had an aggressive selling day, but the value area was overlapping here. It's pretty ineffective despite some heavy selling numbers here. Pre-open on this Tuesday, I said that the half range of last year's high was the natural resistance in a bear trend, so this is a crucial point for the rally. They went on to say the price above this level would be a big positive. That's what we got the following day, so we had aggressive buying here with the value area largely above that level. Following day, value area above that level, and again on Thursday with aggressive buying. So it's all been pretty positive price action for the last couple of weeks. On the live chart here, here's the level we've just been talking about, and we are higher again today. As I said, the breadth numbers improved again. They have been for a number of days, and pulse chart certainly improved. We can see the improvement in the breadth here from this long period of red. Comes from the daily breadth chart. These two indicators here, much improved. Net new highs 25, 5-day moving average above 0, and the percentage stocks in my New York list above their 50-day moving average, well above 50, and that's why we have this solid green bar now, along with price momentum, which again has gone from a long period of red to a positive period here and heading higher. So price momentum from about this point here looking much better, and now having held the 187 time support, once it had crossed back above it, we are now above this important, this is the spider chart levels, we're now above 197.40, this important half range. So that's now really important support on this chart, and if you're bullish you want to see price holding above this level. This is the diamonds we're looking at here, again holding above its major point of control at 164.25, and now above the half range. So from the low in February above the minor point of control, we've just been seeing improved price location all the way up here. Undoubtedly we're getting overbought, but you can see, unlike this point earlier in the year, we're staying overbought on this daily chart, as we did over here in this period through October. In the short time frame at least, the Russell 2000 ETF here, the small caps, doing just as well, if not relatively outperforming the large caps, which is always a healthy sign. In the longer time frame you can see that we're still quite a way below its half range of last year's high, so from that perspective still lagging, and should that be reached that will likely be strong resistance. On the Qs chart we had the major point of control at 101.30 here, and that has actually now migrated higher up to 105.13, and we appear to be just consolidating just above that level, hoping that this chart can maintain that position above that level. This is the UK FTSE 100, which has closed up about 1% or just a little more today on the high of the week. We spoke about this chart last week when we saw this higher low pattern on the major point of control of 58.70. I said that can be a very powerful pattern. We're up quite strongly from there. There's the obvious natural resistance, like the Russell chart, a little higher, which is the half range of this high. We also looked at the DAX chart last week, and noting that unlike other indices, it was still struggling to print above a 96.65, which was its major here, and I'm glad to say we've seen a reasonably strong close this week, and again hoping that the chart can maintain its position above that level going into next week. This is a screenshot from last Friday's video. We were looking at the 7 to 10 Treasury Bond ETF, IEF, and we're looking at the weekly chart here, as I say, as of 1 week ago. We're just looking at this overbought level on the weekly. This is a stochastic momentum index, and I just noted that in the main, where the chart reached this level of overboughtness, there's usually at least consolidation and more usually a decline in prices. And if I just update that on the live chart here, we were looking at this here, this indicator here. The chart no longer overbought on this indicator, but we are seeing now the price itself correcting here on the low of the week. I did also show a similar chart for GLD, the gold shares ETF. Again, very overbought, and we looked at previous instances of that over the last 2 or 3 years, and again it seemed to bring in the tops of corrections. But what I said last week, I identified the fact that the chart had moved above its major point of control into a much stronger price location, and that's why the current situation was different to these. And here we are on the live chart, and GLD has held above that point of control. Again, this is a weekly chart, and we're staying overbought here. I think of premier importance, the price location, as you know, I think wins out. So let's look at the daily chart, and you can see when the major point of control moved up to this level. In here we found support on that point, and this consolidation looks to be breaking out higher now. One big positive for equities is the price of oil at the moment, because it's rallying. It's been dragging equities lower the earlier part of the year, and we were watching this halfway point of this low here in this range, and it appeared that we had this higher low pattern on that halfway point, which can be quite a strong pattern, and we're now breaking out above the height of that range, and this will draw some attention, especially if the chart eventually manages to break above this level here, just above 38, because that is the high for the year. So if oil could set a new high year to date, that would be, I think, something that would attract a lot of media. Dollar index was doing well off this low here, crawling its way back above this halfway point, and subsequently above 97.40 as the point of control moved up to that level at 24-month point of control. But currently we're seeing weakness at the end of this week, and we're printing just now just below that level. If you're bullish on the dollar, you'd want to see price back above 97.40. Just in terms of bar chart analysis, just looking at the weekly bar here, we're still holding above last week's low. So this week gives us a higher high, a higher low. Just switching to daily bar, the first minor level of this low would be the halfway point here, and that's not been breached yet. Big component of the dollar index is the euro. We're looking at the euro FX chart here. It was printing below its 12-month point of control earlier in the week, which was really weak price location. That's reversed, and in the short time frame, as long as we're holding above that 12-month, it's in a stronger price location. We still have the halfway point here, so I'm not reading too much into this very minor rally at the moment. Price back under here again would definitely suggest lower, I think. This is the pound against the dollar, much weaker price location than the previous chart. We know back over here, all this big resistance up here caused a real problem. We then saw a price below this half point of this low to this high, and that put it in a really weak position. We've seen the sell-off. The first level that would indicate strength is price above here at 144.08, which would be above the 3-month point of control. And with the possibility of Brexit and the uncertainty over that over the next 2 or 3 months, we're likely to see this chart quite volatile. I'm going to consider it in a weak price location below here. Another screenshot from last week's video is the Australian dollar, and we were discussing the 12-month here, at spot 71 exactly. And I said the price underneath here would be really weak and suggest a retest of the low. On the other hand, there was the possibility, I drew this in, of this higher low coming in and finding support here and giving us a higher low on a point of control, which can be quite powerful. And actually, that's what we've seen. Here's that level. It was never actually broken, and we did get a sort of minor higher low at that level, and we are moving out of this range now. So this looks quite correlated with the gold chart, not surprisingly. And just note that that point of control actually did move up, and you know it was the halfway point as well here. It did move slightly higher up to here, and that's the level we now watch for support. But I don't have much resistance until we reach this major level here, which is spot 76. Okay, let's jump into the sentiment charts to finish. This is the Ridex I've been showing day to day. This was the lowest level in the Ridex, or my version of the Ridex ratio, since July 2013, corresponded to this low here as we broke below the October low. So at this point, investors more bearish than they've been, according to this indicator, since that point. And the market, we noted this last week actually, the market has rallied really strongly, and the Ridex ratio has been very slow to respond, indicating that the retail trader does not trust this rally, which is usually a bullish indication. They will, if the rally continues, they will suddenly respond due to the fear of missing out, and then we'll see this start moving higher if the rally continues. That would be the expectation. We looked 2 weeks ago at this chart, which is the Ridex bull funds assets in isolation that I follow, and we noted that when the assets in the bull funds fall below this level, over the past few years it's indicated the point where the market usually turns back up, it's refueled and it's ready to go again. So this was 2 weeks ago, and we noted the assets were below that level again here. And if I update the chart, you can see, yes, it's the market's rallying, but again, bull fund assets just slow to respond. Again, 2 weeks ago we saw this, which was the, when it broke above here, this was the assets in the bear funds in isolation. They've reached a new high over here since November 2011, extreme bears here. And again, if I update that, we have seen bear fund assets fall. They're still elevated, haven't fallen by very much. So we will watch the ratio day to day and watch out for that suddenly spiking higher. And the public poll from AAII this week, the bulls percent was slightly higher at 32%. 7 weeks ago, which is over here on the chart, bulls percentage fell to 17.9, which was the lowest reading since April 2005. And bears percentage was lower at 29.2 this week. 3 weeks ago, the bear percent reached 48.7, and that was the highest. So that bull Investors Intelligence, the bulls percent was higher at 36.4% this week. Putting that in perspective, is up from 24.7% 3 weeks ago. That was the lowest bulls percent since 2008. And the bears percent was lower this week at 34.3, down from 39.8 just 2 weeks ago, which was the highest since October 2011. Good indication on this chart is to watch that 4-week moving average of net, and when it breaks below the previous extreme low, usually marks an extreme bearish sentiment. Active money managers, the exposure index, from being too low, below 30 just a few weeks ago, is now rallying back up, currently at, I think it's about 52. This is actually last week's comment. We're just up quite a bit this week. From a contrarian perspective, there's very little to worry the bulls on this indicator or any of the sentiment indicators currently. Here on the Lipper US fund flows, they reported equity fund, including ETF outflows of 2.4 billion in the week to the 2nd of March. And the 4-week flow in black at the bottom there, still slow to pick up. Okay, that concludes this week's video. Once again, I wish you a good weekend, and I thank you for watching. Thank you.